All right, guys, here we are, another Tuesday. And we're back in today's bond trade. So if you thought cooler inflation and weaker retail sales was going to automatically give us lower mortgage rates, the bond market just reminded us today, to everybody who's looking at this, that there's somebody else who runs this whole thing. We finished last week with mortgage rates near their best level since the middle of July. Then Monday morning, Iran escalation, a UAE tanker gets seized in the Strait of Hormuz, and everything starts climbing. Again, treasury yields go right along with it. Mortgage-backed securities got punched. The 5.5 finished Monday at 99.15-ish, and the 10-year treasury moved back above 4.7. And this morning, the pressure is getting worse. Oil is above $90 a barrel. The 10-year is around 4.74. And the 30-year treasury just touched its highest yield since 2007. Now, here's what matters. This isn't simply the market saying the Fed is going to raise rates. In fact, the recent softer economic data has actually caused traders to reduce some of those expectations altogether. The problem is further out on the yield curve. The bond market is looking at expensive oil, the Iran war, the Strait of Hormuz, the massive government borrowing, the corporate debt issuance, and the persistent inflation, and saying, if I'm going to lend you money for 10 or 30 years, you're going to pay me for it. That's the trade. Remember, your mortgage rate is the bond trade. Now, so let's go to the chart so I can tell you about what we're seeing out there. That's kind of where everything is getting viewed, right? We get to see what's being affected exactly. What I'm watching here on the MBS 5.5 right now is the 99.54 area. So right up in here. This is what I'm looking at down in here. So you can see right here, we got a little bit of resistance. 99.62 is our really heavy resistance. Look at this. It starts banging around right up on there and coming right off of it. That's the first wall to get through. And I want to see us not only get there, but then see if we can get above some of these other areas that have shown to be some pretty heavy resistance there. But what we've also got is support down here at the bottom. That support is what's helping us from getting too far down. As we can tell, if we go in the past quite a bit, has helped us a lot down here. But look at this. We've got more. We don't have very far till we hit that support. And then we're going to, I believe, trade just in this range right here. This 99.93 to 99.95 up in here till we get into this area of 99.62. This is going to be our place. I believe we're going to trade, and it's going to move mostly to what's happening out in the marketplace. So what are we going to do? We're going to watch it. We're not going to confuse bounces for breakouts. We're not going to build our family's financial future around guessing what Iran's going to do, what the Fed is going to do, what Wall Street's going to do. What you need to do is remember, you control the asset. You control the leverage when you get it for 30 years, right? Now let's take a look at something else. This is another one I think is just important for everybody to know or take a look at. This is Mortgage News Daily. This is a site that you should be going to and looking at and seeing where things are moving. You can't look at what I've got unless you want to pay the fee. It's not very cheap to have the access to that. But this tells you kind of the same thing. You get to see the trend of where we're heading. We're heading downward, rates are going up. We're heading upward, rates are going down. Now, this is something you need to be aware of. 30-year fixed mortgage rates as it's referenced here in this particular item, this site. Mortgage News Daily is talking about the average person buying a house to live in, not you as an investor. So when they're saying the 30-year fixed rates to 6.73, we're talking about good credit, 20% down likely on a property a person is going to be living in, not for your investment. So when I hear from people, hey, the investment rates are so stinking high, why are we above 7%? 6.7 right there for a person buying a house to live in. Traditionally, if you look at Fannie Freddie rates right now, you look at the conventional rates for the real estate investor, your GSE rates, or what they call conforming rates, those are pushing 7.7, 7.8. If you're finding a really, really cheap bank, 7.5, that's what you're looking at. Right now, our DSCR rates are way below that. So when you're telling me, oh, these rates look high, understand where we sit. We're in a really, really good spot. If you can buy a property with an LLC that has a holding company, that has some buffer between you and your personal assets and that real estate, and get 30-year fixed financing on, and it's not far within 0.5%, 3/4-ish of that rate right there I just showed you on Mortgage News Daily, what are you talking about? You need to jump in there and make that trade. You need to quit jerking off and get in the deals.